Good morning, everyone. Welcome to the evolution of VC, What's Next? I am so excited to have this panel and really inspired not only by these incredible venture capitalists, but the women that are behind them. So as many of you know, venture capitalists, it's their job to identify the kind of companies and the kind of world that we want to live in, and then invest in those companies and build them out and support them. And they usually come on early stage and are there when no one else believes or no one else understands. And it's incredible what these three up here have been able to do in that capacity. But the thing about it is that, as a lot of you all know, the evolution of VC is really changing. It's in flux. There's a lot of different elements that are at play. So we're going to take a look at what some of those challenges are and what some of those opportunities are with our incredible panelists and moderators. So first up, right here, and thank you for wearing such a great color. You stand out. I love it. We have Laura Chau. She's a general partner over at Canaan. It's an early stage venture capital firm where she leads consumer technology investment practices. She sits on several different board positions, including Clutch, Ollie, and Mosey. And actually, she was one of the first employees over at Kabam, and that was actually a portfolio company that Canaan acquired there. She hosts an incredible TV show, Hot Deal Time Machine. Great name, by the way. She was also one of Forbes magazine's 30 Under 30 and has an incredible science and engineering degree from Stanford and her MBA from there as well. And right next to her is Jessie Draper, who's smiling, who is also my neighbor. She's just great. I see her with her three boys out there, and she is incredible and the general manager and founder of Halogen Ventures. But they really focus on consumer technology. She really takes a look at investing in female founders and different co-ed teams. She has over 70 different portfolio companies, a lot of them that you've heard of. They've sold to other smaller little companies like Walmart, P&G, Twitter. Also hosted an incredible show in this space as well. And maybe if you don't recognize Draper as a last name, she's a fourth generation venture capitalist, so I think it just runs in your blood there. And she loves it when I bring that up too. And then next, our next panelist, who actually got a huge win under your belt, which we'll keep to ourselves for now, but very happy for you. Rana Yared is the general partner at Balderton, which is based out of London. She was formerly a partner at Goldman Sachs, and this woman has worked in some of the biggest companies and really has had a unique and interesting perspective into venture capital. She also did her undergrad and graduate school at the University of Pennsylvania. As you can notice, they're all from real up-and-coming schools. That was a joke. This is, of course, our wonderful moderator, Maureen Austin. She is a general manager at Cambridge Associates based there in Boston. Before that, she was at Bernstein. She advises high net worth families and institutions. She's worked at some major companies from Danaher and Eaton and Gunton, really knowing their P&Ls, and went to Harvard, did her MBA there as well. And I'm going to stop talking now because you're not here for me. So put your hands together for this incredible panel on the evolution of VC. What's next?
Thank you, Sarah, for that lovely introduction. It is great to be here at the Montgomery Summit. This is my third time here, and I always learn so much. In fact, after my first attendance, I penned a paper on the flight home, which later became known the 40% paper amongst my colleagues at Cambridge Associates and more broadly within the industry, which advocated for investors to think about allocating more to the private investment space, especially venture capital, given the technology transformation underway. We did not advocate for it to all be deployed in 2021. I just want to be clear about that. But many thanks to Jamie and Sumant for hosting this. It is, once again, not disappointing on the educational front. And we have learned a lot in the last 24 hours about venture, the good, the bad, the ugly, I call it. I am honored to moderate this panel of very talented venture capitalists on stage today. And I'm very excited to hear their views on what's in store for venture going forward. I have a long flight home, so I may write another paper.
Okay.
To start that off, could we take a moment to reflect on the past as to what's happened before you embark on where we're headed?
Absolutely. So if we just rewind the clock back to the great financial crisis and then look forward, for the last 14 years, money has been incredibly cheap. I think we can say that collectively we've all been in this collective amnesia moment where we forgot the times gone by where business models mattered. We then woke up with the collective shock of the end of the Fed put, supply-side economic constraints, the start of demand-side economic constraint challenges also, the war in Ukraine, and some pretty meaningful challenges on the inflation front. And what that collectively has meant is that the money that was cheap is no longer cheap, and the cost of capital has gone up. And the most common question that gets asked now is, okay, but we've been suffering since December, surely it's almost over. And history tells us that it would be very reasonable to assume that it's not. Why? Because if you look at what happened in 2000, you had the original dip, a small recovery, and then a long dip that went almost another 18 months. If you look at the great financial crisis, we collectively associate it with bear going down in April of 2008, or perhaps the Lehman bankruptcy in September of 2008. But actually, the low point of the S&P was in March of 2009. And so if we look at what's happening now, yesterday the S&P closed at about 3940. Before the pandemic started, we were at 3380. And no one was thinking then, gosh, the stock market is weak. And so if you take history plus the 2-year run-up, it would not be unreasonable to assume that the market contractions and the multiple contractions that are happening now are not necessarily done 6 months in. So what does that mean for venture? My 2 cents. It's a time to tell the industry and our portfolio companies collectively to pause, reassess, and really find where the efficiency frontier is between growth and cash spend, so that if indeed the worst case scenario is going to happen, which is that this is not an episodic 2-quarter dip, that companies are in a position where they can actually ride out that storm and have the best companies emerge on the other side ready to continue to grow. I mean, luckily for venture capital, we are in the secular, not cyclical business, and so if we collectively preserve well through this downturn, in the long run, we're investing in trends and businesses that will prevail.
Go ahead. You had.
So, I mean, I have to say I have a solution to this, which is we need more capital going to women. We have 70 portfolio companies, 100% are female founded, and I've been so impressed by our founders because women raise less capital. They raise 2% of venture capital funding, but all of my companies have always been focused on profitable growth. Growth without profit was foreign to them when I sat down with them in the beginning of COVID, being like, what are we gonna do? We have this big Zoom call, I'm like, conserve cash, and they're all like, I'm 10 steps ahead of you, Jesse. Women raise half as much capital, they double the return in a year less time. And anyway, I just want to present the solution.
Well, Rana, you made a great point around capital being very cheap over the last 10, 12 years. And I think one of the things we've seen is that there have been so many new funds that have come out and many funds that have raised a ton of capital. And what that has meant historically is that we've had this huge rush to invest. You made the comment of all these funds deploying everything in 2021. And I can tell you from what it's felt like, and I'm sure many people here have had the same experience, deals were getting done in a day, 3 days, and the opportunity to do deep diligence really kind of fell by the wayside in many cases. And I think what I saw a lot of investors do is look for proxies because these deals were so competitive. They were looking for perhaps an archetype of founder in many cases. I can't tell you the number of times I saw deals that were 2 engineers coming out of Plaid or Stripe or Slack with a PowerPoint deck and an idea, and we're raising $12 or $15 million, right? And not to diminish the ability or quality of those founders, but in many cases, you don't have product market fit yet, right? And that's a lot of capital for an idea. And I think we're starting to revert, perhaps, to having a bit more time to do that diligence, having a bit more time to look for these founders, and I think that archetype might be changing. And so looking to the future, since this is kind of the evolution of venture, I think I expect that we'll have more time, but I also think that there's an opportunity to find real diamonds in the rough when it comes to founders and companies. And so what does the archetype look like for a founder who is thinking about profitability, or who can think about being really, really scrappy with limited capital, because the cost of capital will be different.
I completely agree. Because we put out this, I call it the Batwoman Signal, and we said, hey, we're looking for incredible female-founded technology companies. And I started doing that about 7 or 8 years ago. And at first people thought that we were crazy. Now we're seeing 10,000 deals a year, and we're attracting over 50% minority-led companies because access to capital is attracted to the Stanfords and the Harvards and the Stripes and those backgrounds. And because we started saying, hey, we're looking for women, we're seeing a much more unique diaspora. And we really look at companies at the earliest stages saying, okay, we think diversity of gender, age, and race breeds success. And the data's there now. It's proving this out. Our data is proving that diversity of all of these things create much stronger, better businesses overall. But access to capital is a real problem. We can't keep going down those same rabbit holes. However, we have a few Stanfords and Harvards in our portfolio too. I don't think you discount them, but you need to make sure that you're seeing everything. We as venture capitalists have a responsibility to see as many deals as is humanly possible. We are supposed to be taking these pitches and seeing everyone.
Laura, I want to jump on the point that you made about the archetypal CEO. That archetype point is true actually not only of who we invest in, but who we hire to do the investing. So, there's kind of long been the archetype of like investors need to be, I hate this word, aggressive, right? When I hear aggressive, I think, oh my gosh, I don't want to spend a lot of time with you. But it's actually been like the call signal for like someone who's willing to win. And when, in my previous life at GS and now at Balderton, when we think about, investing in the best investors, we don't think about the word aggressive, right? The word is assertive and with a point of view. And when you change a little bit the way that you talk about what investors you are looking for, you then, to use your words, send that bat signal out into the community that you have a little bit of a different view on what wins. And that does the same then, for the archetypal CEO. So for me, there is no archetype. When I think about the CEOs that have been the most successful in the portfolios that I have run, they have been, either immigrants, women, people of color, slightly nerdier, definitely not like the cool, aggressive person. And the biggest reason for that is that there's a lot of good research that says that doubt in small doses is actually very powerful for success, because it makes people reevaluate whether or not they're making the right choices. And as information changes, they're actually willing to change their minds. Whereas the characteristics that are historically lined up with, quote, aggressive, equal very, very high confidence and an inability in challenge times like these to actually change their minds and pivot. And so that archetype changing in the long run actually not only adds diversity into venture, both on the investing and founder level, but also should lead to better long-term return results.
I agree.
It's amazing. I don't even really need to moderate this panel. You guys can talk about things all day long. It's fascinating. So can we take a moment to come back to this comment that was made about the archetype and the diligence and the proxy and some of the statistics, Jesse, that you shared and Rana, you shared. How do investors think and reflect on the biases that are implicit in what is the marketplace of venture capital, and how do we change that to the betterment of LP interests, betterment of founders? And why don't we start with you, Jesse?
I mean, I think the world is changing. The world of venture capital is changing. I know there's so many, who's a fund manager here or works at a fund partner? We're doing a ton more SPVs. The entire structures are changing. People are trying to figure out how do we make the returns for our investors that we used to. And I think we need to see more change. As LPs should be investing in funds doing something a little wacky, a little different, because I think you're not going to see those traditional returns in the traditional venture capital funds anymore, because those are not venture capital funds anymore. Those are PE funds. A lot of them have turned into RIAs. So I think those are a couple of the things you should be looking for. But look for unique, get in new networks, get into new mixes of people.
I mean, I would add to that, measure yourself. So it's super obvious that you don't need measuring because you're a female GP investing in women, so it's clear that you've covered it. But I'm from a more traditional venture capital firm, and those more traditional institutions are the ones that I have grown up in. And it's easy to say we believe in diversity of both the investing team and our founders. But you need to measure yourself. So what we ended up doing at Balderton is we signed up to the UN PRI. We put out our sustainable future goals, and then we audited ourselves 1 year in, and we made our audit public to everyone, not just our LPs, in the autumn. And doing that, I think, helps you hold yourself not just to a higher standard, but helps tell the world that you care enough about that standard that you're going to measure yourself. And so doing that has actually attracted LPs who have said to us, we have chosen you over others because you didn't just say you were going to do this, you actually then
have the data.
You have the data, and not all of it is flattering, right? Some of it says, here's where we need to do better, and next year they'll be able to look at that area and see if we actually did better or not.
I do completely agree with that. I think we need more data-driven VCs. It's not just, someone who's like, I think I'm going to raise a VC fund, and you need to do the work, especially now.
Absolutely.
Especially now. So Laura, you talked about diamonds in the rough and the diligence process. Can you elaborate a little bit more on what changes are being made to the sourcing strategy to find the diamonds in the rough?
Yeah, I think there's some structural things that have been changing, right? I think you see a lot of funds that are being much more data-driven, right? They're looking for signal in kind of companies that are starting to pop based on different metrics, so that you take out a lot of the bias that might come from looking for that archetype of founder. I think there are a lot of new funds that have come up where you're seeing, and this might change, but you've seen such a plethora of pre-seed funds, and so there's more and more companies that are getting funded, which does mean more diversity in many of those companies. I think, again, perhaps a lot of capital has been poured in there, and we'll see what happens as that goes forward. But it means that there's way more companies to find. You saw 10,000 last year, right? Like, that's an insane amount. And so I think from a venture perspective, we have to make sure that we are all evolving so that we can process those deals and see them in a way that is fair, in a way that is not just focused on a specific archetype, but also still take the time to do real diligence, right? And I think we are coming into a period where there will be much more emphasis on that and more time to do it. And it's going to be the companies that have really strong fundamentals as well as fantastic teams that go on to that next stage.
And certainly thank goodness for that, right?
Yeah,
I mean, there
absolutely.
were moments last year where I felt, I don't even know how I can be good stewards of our LP's money if I have to turn around a decision in 24 hours. How can I possibly? And so to kind of get back to a world where the fundamentals matter, where the DD matters, where we can make sure that we're being good stewards, we can focus on the outsized returns as opposed to speed, for the industry actually makes us more thoughtful, because whenever one of us trips up, it's actually the worst disaster that the LPs remember the most the next time any of us go to raise.
So don't trip up. No one trip up.
No one trip up.
Well, I think it makes the VCs more or better stewards, but it also, I think, is a good thing for many founders, right? It's forcing everyone to be scrappier and preventing potential kind of down rounds or situations in the future that are not kind of serving anyone.
Yeah.
Well said.
That's great. Okay, so we had collective amnesia, we had youthful exuberance, we deferred to an archetype instead of due diligence, but there's an opportunity for diamonds in the rough, reflections on bias. Rana, let's come back to some of the doom and gloom we've heard, which you also emphasized here earlier. What should VC investors be expecting over the next 12, 24 months, and then the 5 to 10 year horizon that can get us through whatever is headed our way and get excited about what's ahead?
Maybe just starting with the most exciting thing, which is to reemphasize, we are investing collectively in secular trends. So 10 years out, no matter what is happening really today in the market, backing the most interesting changes in consumer, in fintech, and enterprise, and biotech, that excitement is going to still be there in 10 years' time. So knowing that the companies that we're seeing at seed and Series A today will ultimately really not be that affected in the long run if they're a great company by that outcome. So the questions that we ask ourselves is, what can we do to help our best companies get through this moment so that they can see the other side of however long this cycle is? So that's kind of the focus that I have. It's the focus that the firm has, which is excitement and focus to get to the other side.
Yeah, and just to tag along to that, you know, you look back at the last recession and we have Uber, we have Slack, we have Stripe, we have so many incredible companies, and what's broken now? We just did this huge study in the future of family. Childcare is broken. I know there's so many parents out there and there's so much opportunity there. That's from ed tech all the way to childcare facilities to any kind of tech products that they use. That's a $7.5 trillion opportunity that is essentially untapped because women care about it more and men control the majority of the capital. So I know a lot of you men care about childcare, so you should be investing in this vertical as well. But there's a lot of opportunity and broken systems that we've found because of this pandemic.
I won't say much more, but you know, if you look at Twitter or you look at the news, it feels very doom and gloom. But Rana, you're right. These are long-term investments, long-term trends. As early-stage investors, you're betting on a future that's 10 years out, and I think that's pretty well protected. And yes, maybe valuations might correct a little bit, but I don't think that's a bad thing.
That's a very good point, Laura. I mean, it's for long-term investors, right? We always emphasize the need to shore up your liquidity, have a long-term perspective, expect the J curve. We didn't have a J curve for 2 years, and I think people thought you just put it in, it goes up and to the right. So there'll be just a little bit of expectation resetting, which I think will probably be quite healthy. What advice do you have for founders looking for funding in this marketplace? Let's start with you, Laura.
It'll sound funny just given kind of what we just talked about with the doom and gloom, but I think stay optimistic, right? I think founders, especially at the early stage, their superpower is being able to be optimistic, to have a vision of the world and create it, and to motivate their teams to build it. And so I think that should not change. What I would say is having that dose of realism in their back pocket will probably differentiate the founders who are able to navigate the bumps that are coming up.
Yeah, I would say focus on profitable growth, you know, grow, but, you know, really keep your eye on that EBITDA. And I would say focus on that and solve enormous problems. Also, you can be picky about your investors too. Find ones that will be helpful for whatever it is. You know, if you're in healthcare, make sure you have some great healthcare investors. You know, you can be picky.
In addition to just echoing those 2 points, I would add to that, take the time to build the relationship with whomever you select as an investor. So you know, it's been too often a drumbeat of the last 3 years that goes something like, I took money from X, but then I got to know why would have been better. Take the time to really get to know those who are courting you, even if it means like making all of us work a lot harder, and make sure that you are in a long-term partnership with someone who not only supports you when the times are excellent, supports you in the kind of economic cycles that exist now, but also supports you when things go wrong outside of work, because you're all people. And you know, as VCs, we have to collectively understand that we're not just here, you know, to make sure that we help you nurture your company, but that if you yourself and your team need something, we're actually supposed to be there to also help you through the difficult personal moments that, if not helped through, bleed into the overall like outcome of your businesses.
So a recommendation that everybody get back to doing their diligence, right? Their diligence on founders, their diligence on investors, Absolutely. Their diligence on opportunities. In the remaining time we have, can you talk briefly about the importance of governance and the role that venture firms play in a company's evolution on that path, and whether or not there is the ability to impact the governance of a company that can keep it on a better trajectory? I think we'll hear a lot more about governance, is my point. In the future here, I've been watching a lot of Netflix shows about companies that didn't have good governance.
Well, I was having a conversation with someone earlier where over the last 5-7 years, there have been so many companies that have so much capital and founders have so much opportunity and so much power that the opportunity for really good governance has in some ways fallen by the wayside. And there's a point to having governance, and I think there's a real benefit to having it. And I think the funds that have seen downturns and have seen corrections in the market or just seen more difficult situations are going to be the ones that can really help steward these founders, right? I think there are going to be a whole slew of founders who have only ever seen a bull market and have only ever seen great times. And I'm not saying that the sky is falling by any means, but I think, you know, having investors who can help in that process will be a real boon to those companies.
recognizing that we're all collectively talking our own book on this, right? I would say that being a CEO seems like a very lonely undertaking from my point of view. There's no one in the company and no one at home that you can be really 100% completely honest with without freaking them out just a little bit. And so even though, I would say there's a propensity among venture capitalists to overblow the impact that we have on companies, I would say that the place where we can help with that loneliness is that founders shouldn't see governance as a diminution of their power, but rather should think of it as building a council of advisors with whom they can kind of lay off that burden as they walk on that lonely road, whether it's small things or big things. And again, to not overemphasize kind of the impact, it's not like governance and a VC says, okay, you should be on this path, you're accidentally here, I'm going to bring you back. It's actually a series of micro conversations that have half-degree effects each time that keep you on the right path collectively. And so, again, back to doing the diligence to have the right relationship, you can't really have those micro discussions if you don't have the really good relationships, and thinking of it as a way to kind of deburden yourself and actually make your VC serve you as a founder versus I am giving them power, basically.
I totally agree with that, because I think there's the far end of governance, which is kind of the legal decision making that you have, but I think most of it is kind of soft influence along the way.
Correct.
Yeah, the best founders I work with, I'm on a board of one, and they're constantly saying, what are you VCs seeing right now in your portfolio? What are they doing? And I think often founders forget that we have this great bird's eye view, and we know all of their competitors, and we know what everyone's doing in D2C e-commerce, and we know we're seeing patterns, and you can always ask those questions. Don't feel like you're stuck in your bubble, to Rana's point.
That's wonderful. Well, I thank you, Laura, Jesse, Rana, for your wonderful insights. I'm more optimistic now than I was 2 hours ago. And it'll be really exciting and interesting to see the next 2 years. Not that the last 2 years weren't interesting, but leaving this conversation very excited about the future of venture and what's next. So thank you very much for your insights.
Thank you for moderating.